Let's get started. Welcome, everyone. My name is Sue Mazzetti, and I'm a partner here at Quorum Private Wealth. Thank you for joining us for our mid-year market outlook. And boy, what a start to the second half we've had. I'm joined by a very special guest, Ann Bartels. She is the Chief Investment Strategist for Sanctuary Wealth. Ann is very well recognized and award-winning strategist with more than 40 years on Wall Street. I'm sure many of you have seen her in the financial news. She's a frequent guest on CNBC and Bloomberg and Fox Business. She's often quoted in the Wall Street Journal and the Financial Times and Barron's. We here at Quorum have been very fortunate to have access to her great market perspective and investment insights, both through our time here with Quorum, so through our partnership with Sanctuary Wealth, but also in our many years at Merrill Lynch. She had a very illustrious career at Merrill Lynch. And I can personally attest to the fact that Ann is a rock star amongst the female financial advisor community. So I was very honored in May to moderate a panel that Ann was on. We were at the Forbes Women's Top Advisors Summit, and it was hard to walk across the room with Ann. She was stalked by all of her female financial advisor fans. And so huge warm welcome, Ann. Thank you so much for being here. Really excited to see you today.
Oh, it's my pleasure. And thank you so much for having me.
Great. So Ann, you and I met 2 weeks ago to do a prep call and flush out what our topics of discussion would be. And I have to say, I think we have to throw away that script. So these 2 weeks, the start of the second half of 2024 have been really news-packed, right? So we've had an attempted assassination of former President Trump. We've had Biden step down from his re-election campaign. We had a global technology shutdown last week with the CrowdStrike update. We've had a market correction in kind of the technology mega cap space. So lots to unpack here today, lots of great topics that I'm really excited to get your perspective on. And I think we have to start with the election. I mean, this is quite the unprecedented election. If it wasn't already after the events of the last 2 weeks, it certainly is going to be one for the history books, that's for sure. And we know that markets don't like uncertainty. They don't like surprises. So how do we take all of these events and kind of translate it into what impact this is all going to have on the market, especially in the fact that we still have 100 days or more until the election?
Well, let me backtrack and let's go, because there has been so much that's happened. Prior to the debate between Trump and Biden, my view was the election was not going to have as much of an impact as people thought, because it was so early in the election cycle, and markets really respond to earnings. At the end of the day, the most important factor that stocks respond to over a sustainable period of time are earnings. But that pivoted and did change once we had the debate between Trump and Biden, and we know that that debate was just disastrous. And the market pivoted at that point, pricing in a Trump win. That clear, and you can see it in the betting polls. Mm-hmm. You can see it in the pockets of the market that would be considered favorable under a Trump administration. And even with all, well, after the attempted assassination, we saw his polling, meaning former President Trump, really go up a lot more. The market just really tilted towards a Trump win. I think where we are right now is he's gone way up. Obviously, Biden went way down. Now it looks like it's going to definitely be Harris that will be running against Trump. I think you're going to get some narrowing now. You're going to start maybe see his numbers come down and her numbers come up. But again, we're very early in the election cycle. And I just did a mid-year update with some panelists from KKR, from FS Investments, and from, I can't think of the last firm. I don't know why that firm never stays in my brain. But we all agreed that you don't change your portfolio based on an election. You know this, I'm sure you talk to your clients about this. It's really about setting goals and asset allocation. And there are times you may want to rebalance, but to completely change your portfolio based on the anticipation of who's going to be elected, is really not appropriate. And again, at the end of the day, the markets will respond to earnings. But what will be important are when we do have our next president, which we will obviously have a new president next year. Trump is more of a known. Harris is kind of a known unknown. Depending on who wins, you will see maybe certain industry groups favored over other pockets. Let me give you an example. Trump is talking about tariffs and big tariffs against China. So when China's not a good trade, Trump is talking about the immigration problem that we have on the border with Mexico. He's going to be tough. He's going to be tough on that. He wants to increase exports of liquid natural gas, LNG. So you'll see maybe certain pockets behave a little bit better based on that. We don't really know where Harris stands at this point. I think some people are assuming she'll be similar to Biden. But traditionally her voting record is not consistent with Biden. Biden was a little bit more down the middle. She was a little bit left of him. So it's going to be very interesting to see where she winds up coming into position. But again, it's going to be very noisy. It's going to be very topical because of everything that has happened. Because today we even had the head of the Secret Service step down after a disastrous hearing with Congress. So I think it's going to be top of mind for everyone. But I think we're in second quarter earnings right now. I think that's impacting the market more than anything. So just stay focused on where the earnings are going and what companies are saying about the future forecasts for their earnings.
Great. Right. So I think that is a great point, Mary Ann, about, even though we may come into, this election with our favorite candidate, that we still should look through that in terms of how we invest, right? And so, and your suggestion is really, the markets have baked in everything already. Let's not worry so much about who's actually in office. Maybe there's some tweaks depending on, Trump or Harris and certain sectors that will benefit. But for those of us that have, subscribed to the very well diversified focus on asset allocation, you're saying stay put.
That's time true and tested, and even tested in academia.
Thank you for that. Well, you came into the year, your 2024 forecast talked about the bucking bull for the stock market. And I must commend you on that because we certainly have seen that, right? So while the S&P was up about 15% for the first half of the year, I think the NASDAQ up about 17%. We saw a couple pullbacks, 5% correction in April, little pullback kind of May into June. And then of course we saw a pullback last week as well. Starting to see some volatility come back into the market. So, kind of how do you view that in terms of where we're headed? Is there going to be more volatility? And where do you see the markets ending the year?
Well, the simple answer is yes. And the simple answer is, I do think the markets will be higher by the end of the year than where they are today. But let's put into perspective what markets traditionally do. You normally get 3-5% corrections a year. It's very normal to get a 10% correction within a year. And on average, you have bear markets every 4 years. What was very unique is we had 3 bear markets in 5 years. We had a bear market, meaning that stocks went down 20%. Or the S&P went down 20%. You had a bear market in 18. You had a bear market during COVID, which was a little bit bigger. That was at like a 30% correction. And then we had a bear market in 22. It is highly unusual to have 3 bear markets within 5 years. On the average, it's every 4 years. But it's normal for markets to have some periods of volatility. And I think we do have with the semiconductors. So my view has been mega caps are the leadership. Within mega caps, technology is the leadership, or tech-like. We used to call them the FANG. Now we call them the Magnificent Seven. But the semiconductors, I said, were leading. Out of all of tech or tech-related, I really thought the leadership was within the semiconductors, and that has proven to be correct. And NVIDIA is definitely the leader within semiconductors. And I'm getting signs that the stock could have a significant correction, and it's just a correction. I'm seeing weakness in the semis. And what I think that's telling me is we're getting close to moving to a very seasonal, volatile time within the markets. It's very normal to have a lot of volatility between September and October. And part of that volatility comes from mutual funds, because many of them have their tax year end or their fiscal year end in October, and they're repositioning in September. We look at October as having the big news events, whether it's the crash of 87, it seems, or the great financial crisis. We had markets go down very sharply in October. So that you have notable moves in October, but what people don't really focus on, November creates significant bottoms for markets to rally into the end of the year. So I think we're going to get some profit taking. I do think the bull can buck a little bit harder going into the fall months, and I think we have early signs of that. And then we have a strong year-end rally. So I'm still looking for markets to be up 20% this year, on the back of markets being up 24% last year.
Sure. And taking that one more step as we look beyond 2024. So I know you've spoken and written about that we're in the midst of a secular bull market. Can you explain a little more about what that means, how long that lasts?
So markets have cycles, and they have long-term cycles, intermediate, and short-term. The long-term cycle we call secular, and it means that markets are either in a bull trend or a bear trend. And the bear trend isn't necessarily down. Bear markets are traditionally just trendless. We go sideways, but the downs are big. Normally, those are markets that go down 50%. And sometimes it happens twice within that secular trend. Secular trends can last 15 to 20 years. I believe we're still in the secular bull market. I'm looking for this market to peak out somewhere around 2029, 2030. And we will have another bear market before that. But what it means, markets will go down, but rally and come back again. I've compared the NASDAQ. So I've called the NASDAQ the digital index. And I named that back when I was in my days at Merrill, because I really saw technology as the leadership. And the NASDAQ houses your FANG, your Magnificent Seven. It really is more reflective of the leadership within the marketplace. So I went back and I did a piece of analysis, and I compared the NASDAQ to the Dow, but the Dow from the Roaring 20s. We don't have S&P data back to the Roaring 20s, so I had to compare it to the Dow. And I think, well, I'm projecting that we could go into a bubble. I know a lot of people think we're already in a bubble, or they're concerned we're in a bubble. I don't think we're in a bubble, but I think we're emerging into a bubble. So what do I mean by that? I've also compared the markets back to 1995. We all know about the tech bubble and the tech burst of 2000, but it actually started in 1995. The rally was from 1995, and the markets peaked in 2000. I think we're more in a range of 1995. I think we're in this very early phase of growth in technology. And I do think it could wind up being a bigger bubble with bigger multiples. And the multiple that I'm using is not a NASDAQ multiple of hundreds. I'm just using like the S&P. And in secular bull markets, and I don't know why people don't talk about this, PE multiples, or what we call their price earnings multiples. So we're taking the price of a stock or an index, comparing it to its earnings. It's simple math. Just do a division and we have a number. They expand. Multiples expand in a secular bull market. And your real value happens in a secular bear market. We already had that. We're not going back there. Your PE multiple will trade down, but you're never going to go in a secular trend, ever go back down to that low. So I think we're going to hit new record highs at the back end of the decade in PE multiples. The hard part of my job, if I wind up being right, because I can be wrong, will be the timing of getting out of it, right? Because you have to remember, when you're truly in a bubble, no one wants to get out. It all looks good. It's and the opposite is the same. When you should be buying markets, the news is really bad and horrendous. And when you should actually be repositioning a portfolio, everybody's bullish. Now, I'll tell you what gives me some confidence that we're not in a bubble. Margin debt is a good proxy of leverage, and markets peak on very high leverage. Don't have leverage in this market. That tells me we have a long runway.
Mm-hmm.
So I'm still bullish. I still think this is going to be led by technology, by semiconductors, and other tech related that will benefit from this whole AI boom.
So we saw a little bit of a shift last week, right? In terms of, this bull run in the mega cap, that's been leadership. But you're not concerned that wasn't a bubble being burst, that there's still more runway there?
No, and I'll tell you why. In technical analysis, when you look at the health of the market, you measure it by how many stocks are going up, the net advance, we call that breadth, and we look at volume. And we hit new highs in breadth as tech was rolling over. I mean, it was really astounding to see, because we got other parts of the markets rallying, and it was really a rotation within the marketplace.
Mm-hmm.
And volume confirmed. I got volume. My net volume was also up, confirming. That gives me very high conviction that we're still in a very strong bull market, that it was just a rotation within the market, but not a change in market behavior.
Okay. Yeah, I mean, I think I saw where, if you look at the first half of the year, NVIDIA alone, I think, contributed a third of the S&P 500's 15% return, right? I mean, that's a super narrow.
It's very super narrow. I know people have compared NVIDIA to Cisco, and I think they're totally different companies. I've never seen
why, because I think that's important.
I've never seen a company, and I've been doing this for 40 years, and I'm not necessarily a stock expert, but I can't recall a company changing and inventing on such a grand scale, right? This is, if you listen to Jensen, the CEO of NVIDIA, he's like, we reinvented the computer. Like, every computer now will have to change if it wants to have AI, and they're the only ones with the chip. Eventually, there will be competitors, but right now they have a commanding lead. What we know from companies like Apple and Microsoft, when you have a commanding lead and you have a technology that will be embraced, you own about 80% of the market space. It's 75, 80. And I think NVIDIA is that company. And they shocked the world with earnings. Now, I worked very early in my career. I was a junior technology analyst. And I've worked with many analysts. Analysts should have known that if they were really doing all their checks, they should have known what the earnings were going to be, or close to it, for NVIDIA. They shocked the world. And I actually listened to their earnings call. And what's really fun about listening to an earnings call is listening to the analysts ask their questions. What do the analysts want to know? And one of the analysts asked, or said and commented and asked a question. He says, I worked in data centers most of my career. He's obviously an analyst now. He said, how have you achieved this level of technology? I haven't seen anything like this ever in my career. And the questions that I was hearing I really felt that the analysts still could not or weren't at a point where they could comprehend what NVIDIA has created. They were still trying to figure it out. And that's why we kept seeing the stock go up at the rate that it's been going up, is because the market didn't have that information. It was new information. But when you have things going vertical, and if you look at a semiconductor ETF, or if you look at an NVIDIA, they've started to go vertical. The one thing I've known in my career, even if they really do have good earnings, a vertical ascent does not last for very long. It gets a correction. And I think what the behavior that I'm starting to see is that we could get a correction, and it could be it's going to feel painful. It'll feel painful, but it doesn't mean that it's over, right? Remember, if you're up 100% or if you're up 200%, going down 30 or 50% is normal. And the one thing I learned from my aunt that trained me, she said, Marianne, any asset class that goes up can correct in normal times 1/3 to 1/2 of its move. That's a big correction, but still be in that same trend. And so I'm starting to see, signs. Would I necessarily sell a portfolio? Only if I was a trader, if I was an investor, because I could be wrong, right? You can't time these things, but you can condition yourself emotionally, because if you look at it, it feels painful.
Sure. Well, right. And that's why we subscribe to diversification and leading with asset allocation, right? Because one thing works as long as it does, and then you need something else to balance that out.
If clients haven't rebalanced their portfolio, this is a good time to rebalance, especially if a stock has gotten too big within the portfolio, right? If you've had it for a long time, it's probably now a much larger percentage of the portfolio. So it's all about trimming back to your original weight, which we call rebalancing.
Sure. Well, that's great. Just before we move on to our next topic, I did want to touch a little more on alternative intelligence, right? I mean, we've talked about NVIDIA specifically, but we certainly are on the cusp of another huge technological revolution. You think about all of the excitement, some skepticism, fear, all of those go along every time we kind of hit one of these, right? You reference back to the 1990s, as the internet was kind of being launched and becoming part of our day-to-day lives. And I think it's really hard, I know for myself, to think about like, what will really change in my day-to-day life because of AI. So let's think more broadly beyond just NVIDIA. Where is AI creating productivity? What are things we should be thinking about? Broader positioning, broader, how it impacts corporate earnings, how human resources are utilized.
So I think we're in the very early stages, and we're trying to figure out how to use AI, right? And there's been recent reports out that there's been companies that have spent billions on this technology, and they're not going to see a return on it in the near term. So there's some concern. But I think we need to take a much longer viewpoint, not look at it, just quarter to quarter, but where are we over the next 3 to 5 years, is that it will have a significant impact. But you can also look about, we need to build infrastructure for it. We don't necessarily have all the infrastructure for it. It's really interesting. Electricity has not grown for 20 years in terms of its growth rate. It's been flatlined, and now electricity demand is rising, right? So we know that the power demand will be high, and not just for that, but also for EVs, for the blockchain. We don't even talk about the blockchain. The blockchain is going to need power. Now, the NVIDIA chip is supposed to save on power. It's not as draining, but we're still going to need that infrastructure. Infrastructure is another big story. Data centers. Other companies, old technology companies that we haven't talked about in a long time, are playing a key role. Hewlett-Packard Enterprises, Dell, right? You have to build part of that hardware infrastructure. There's been some concern about software because analysts haven't been sure where businesses will be taking their budget to spend on AI. There's been concerns that they'll take it from their software budget. But at the end of the day, what I learned when I was a junior technology analyst, which was many, many, many years ago, the first invention and improvement is in your chip. Your next one is your hardware, and your third one is software. And you still need all of them, right? You need them as a package. But I think other key investments outside of AI is, as I said, infrastructure, building out. And President Biden has signed many pieces of legislation to improve infrastructure. I like energy, but it's not in a big bull market. It has the best value within the marketplace with long-term potential. And they have great companies with great balance sheets, really good quality balance sheets, but they're not necessarily going to be leaders within the marketplace. Banks have had a decent run in here, especially with the Fed looking to cut interest rates, but I'm still concerned about regulation. I don't see banks as leadership, although they're not expensive stocks. I think part of their business model is curtailed, especially if they get additional regulation from the Fed, which the Fed is looking at. And I don't think we're through the cycle of commercial real estate. I don't see any major hiccup with commercial real estate. I think it will be very selective, and there could be some pockets of regional banks that have some issues. You may see some consolidation in the space, but that's not leadership within the market. Healthcare is not yet leadership. Certain stocks are based on the drug. Obviously, GLP-1 companies have been doing remarkably well, but I don't see leadership there. Select consumer discretionary is doing okay. Companies like an Amazon are in there. Home builders have been doing really, really well. So you have to really know what pocket to be in that space. But at the end of the day, it is about diversification.
Sure. Thank you for that. Well, I'd like to turn into our discussion a little more around the economy specifically. And I also, before we do that though, just want to remind our audience that we will be taking questions. So please feel free to type your questions into the Q&A, and we'll try to get to all those questions in just a few moments. So in terms of the economy, Marianne, you know, there's interesting data. I know this is a big week for economic data as well, but we have seen, while we're still at very low unemployment, you know, we are seeing it tick up a bit. And certainly here in the Bay Area, in the tech space and the biotech space, we definitely saw, you know, a softening of the job market. I think some of the consumer spending data is softening a little. While the consumer is still spending, maybe they're being a little more selective. Maybe credit card debt is creeping up a little bit. What does all this mean? Should we be concerned about the potential for a recession?
I'm not concerned that we'll have a recession this year, but there's definitely, as you pointed out, a slowing within the economy that needs to be monitored. We've seen the unemployment rate go from 3.4, which was a record low, up to 4.1. Whenever your unemployment rate historically has moved up 0.5%, it's been an early warning sign that the economy can have significant slowing. The consumer is clearly changing how they're spending. They still want experiences, but they're being a lot more selective. So I think these are things that we need to monitor. But I don't think the concern is for this year. We have to monitor for next year, though. I think it's more of a next year thing. The other thing I'm a little concerned about, I think earnings are going to be very strong this year, but the forecasts for next year are even stronger for this year. And I think the comps year to year are going to be tougher. And that's not priced into the market. Very strong earnings are being priced in for next year. And markets tend to discount 6 months ahead of time. So they're starting to discount going into 2025. And right now they're looking for very strong earnings. If those numbers start coming down, that's going to be a little bit problematic. So I'm more concerned about next year than this year. Definitely a slowing, and we do get second quarter GDP this week. And we haven't talked about inflation, right? The Fed has a dual mandate of having full employment and low inflation. And inflation has been sticky. core PCE has been at a 2 handle. CPI has not. As long as core PCE comes in line or better than expected, meaning lower, I think the Fed has the all clear sign to begin cutting rates. The question is it just once this year? Is it twice? The market is starting to look at possibly November, December, but I'm also now seeing many start to forecast rate cuts into next year. The sign that I'm looking for is I'm watching 2-year Treasury yields. We think interest rates have peaked, and they are coming down. The market is pricing in 100% a Fed rate cut. At this point, if the Fed doesn't cut rates, the market won't like it. Stocks will go down, yields will, it would not be pretty.
And you're thinking September. I mean, that's what the market seems to be suggesting is a
Yes,
25
at their
basis
meeting,
point
they'll cut 25 basis points. But I'm
I
watching
just also add that we wouldn't expect a real change to the markets. That's what is already baked into
correct
today.
25, which means if they don't do it, or if the market starts anticipating they're not going to cut, we will have volatility. We saw that last year. The market consistently looked for Fed rate cuts last year, and we didn't get any, but the market was still up 24%. And the market all this time has been looking for a rate cut. We might finally get it in September. So should we not get it, it's not a negative sign, but I would say if they didn't cut rates at this point, it would cause a lot of volatility within the marketplace.
And then you think going into next year, what do you think the Fed has in store,
So I think it's a little too early. I think we need a little bit more data. But what we do know is the first year of a new term of a sitting president, the markets tend not to do well. They're not necessarily, it's not necessarily a bear market, but they tend to not perform well. Believe it or not, second term Republicans tend to have down markets in their first year. Hence, if Trump is reelected, it would be his second year. He'd be Republican. From the seasonality of the presidential cycle, we should not have a good year next year. So I think the bucking bull will be bucking a lot next year. That's my sense. But I don't see it this year. I see more problems happening next year. The other thing to keep in mind, the first year of a new president, and okay, Trump would be a reelected one, they tend to do policies that are not popular, right? They don't need to have voters happy in their first year. They need them happy in the third and fourth year. So you tend to see the third term of a president's cycle where they really start stimulating an economy. And we definitely had that last year, right? And part of that stimulus and Biden's stimulus, and what a lot of people aren't talking about, the Fed technically already started easing. They slowed down the sales of their balance sheet. It's actually a form of a rate cut. So the Fed already has started an easing process. So will that easing process keep us out of a recession? Is it a soft landing? We could also have what's called rolling recessions. We really did see manufacturing in a recession over a year ago. So do we see a consumer? Manufacturing could be recovering, but the consumer slows down. So you can get this rolling cycle within the economy. So, but I don't think it's a major bear market, but definitely volatility. You want to have good asset allocation and good diversification.
Yeah. So, and I know you tend to, strategize more on the equity side, but what are your thoughts on fixed income positioning? I mean, it's been really nice, right, to be able to clip 5% on a money market or a short-term CD or treasury bill. But with the expectation that the Federal Reserve is going to start reducing interest rates as early as this fall and into next year, is it time to extend to start putting?
It is. It actually is. It actually is. And you don't want to wait because the market will begin pricing it in. And it's already started to price it in. So if you are willing to give up your 5% and still want to stay in cash, then stay in cash. But if you still want that coupon, it's time to actually start moving out the curve or into a different product, right? There's a lot of alternatives within the fixed income space.
Sure. And in the equity space, are there particular sectors that benefit more from lower interest rates?
So utilities would be top of mind, and we've already started to see utilities start pricing in lower rates. REITs tend to also favor that, and banks, right? The steepening in the yield curve, which has been, I mean, it's still inverted, but it's been steepening. That actually does benefit banks, and we have seen those banks rally. And I think it's a tactical rally. Again, I don't think they're leadership. I think this is temporary.
Well, you and I have been going back and forth for about a half hour, so I think it'd be great to open it up for some questions. So audience, if you have any questions, feel free to type those into the Q&A. We do have one question so far. You touched a little on this, but I think maybe expand a little bit more too on, in January, we're going to have a new president either way, right? And so how are the markets going to respond to either Harris or a Trump presidency?
It's a good question. And if you recall, let's go back to when Trump got elected. That was a surprise to the markets. The markets really thought Hillary Clinton was going to be elected. And people were shocked to see Trump. But what happened when he got elected? The markets rallied 20%. But the market was positioned to rally. I think it really matters if we get a full correction like I'm anticipating, the markets will actually be in a position to rally. So it's possible no matter who gets elected, the markets rally. That's kind of where I'm seeing things right now.
Sure. Well, and we're past all the uncertainty of what these next 100 days.
Yeah, and then you have your known, right?
Right.
I think Trump is the known. His policies are pretty clear, and we know because he has been president before. So we have confidence in where we think he's going. Harris, even I think she's going to have to prove where she really stands, right? The one thing you have to look, right, in politics, they sometimes say a lot of things, right? But what they say and what they do are different. We also have to remember it's Congress that passes the law, right? They would have to pass it. So the mix in Congress would be very, very important.
Next question is on, let's look globally, right? Out internationally. So, we see deglobalization happening. There continues to be a whole host of geopolitical events going on around the world. Lots going on in China as well. What are your thoughts in terms of, as we look at the international marketplace and how we as investors should think about that?
So let's look at China. China's economy is not doing well. And it didn't get a lot of press because we have so much going on here, right? They just cut interest rates and it was not a planned rate cut. So what does that tell us? Their economy is weak. So I don't think China is really investable at this point. I think also it's like a career risk for many portfolio managers. So I don't see China doing that well. But India is a beneficiary of companies changing their manufacturing, right? Becoming more diversified around the world. And so in emerging markets, I like India. If Trump's
India benefits from the service industry as well, right? I mean, there's a lot of outsourced service professionals.
Yes, very much so. I actually heard an international portfolio manager say, and it was Mark Mobius, I might as well just say that he's been doing international markets forever. He's out of Templeton. He thinks India is where China was 10 years ago, which I thought was fascinating. And then I like Japan. Japan was in a secular bear market for many, many years because of the deflationary events that they had. But I think they're in a new secular bull market. There's a lot of concern that they don't have the population of workers. And I know this is going to sound a little funny. I used to go to Japan when I worked at Merrill. I went to Japan every year from 1999 to, I think, 2016, I never met with a woman. In all the countries I've traveled the world, that was the only country I never sat with a professional woman. They have women, they can work. And I don't think people are taking into account that part of the workforce as much as they should. But I think Japan is going to see a lot of investments. We just did our mid-year, and we had Paula from KKR, and they do private markets, and one of the international markets they're investing in is Japan. And I think Japan, you have to remember, has always had good technology, and I think they will benefit from a manufacturing renaissance. You might even see them building chips, because we are going to need a lot of chips. It's going to take millions and millions of chips to build out AI. If you look at Europe, Europe is very cheap. It's a value-driven market. They don't really have a lot of technology. If we're right that we're really in this AI tech-related bull market, Europe is just not going to participate in that because they don't have the companies, right? They don't have the Apples and the Googles and the Metas, right? They're using the Apples, the Googles, and the Metas, right? So I think that's the disadvantage for Europe. Then we also have to look at the US dollar, right? That you take currency risk into account. And what I found fascinating, we wrote about this in the monthly a few months ago. Every global developed country is depreciating its currency. Everybody, including the United States. But it's still a relative game. And other countries in Europe have already begun to cut rates. Canada, north of us, have already cut rates. So there's a global cutting cycle. Also, when there's a crisis, the US dollar is still considered the safe haven. So I don't see the US dollar weakening that much relative. And that means if you invest in international markets and the dollar stays strong, you actually lose part of that return.
And then one more question, which relates to the private markets, right? So if we think about private equity, private credit, certainly in 2022, that was a nice part of our clients' portfolios, really in a market where both stocks and bonds were down double digits. You know, that space really held up well. But as we look out with, all that you've discussed so far, Marianne, how does that impact private markets, both on the equity and credit side?
So that's a different animal because they're private, right? So you don't have daily repricing in that space. And that's where you get the reduced volatility, right? The pricing and how they price is different. But it's definitely a growing space in client portfolios. I mean, it's something that's old, that's new, right? Private markets have been around. But individual clients really didn't participate in that marketplace because you had to lock up your capital for about 10 years. And you've had the democratization of it in the sense that these both private credit and private equity have created products that are have more liquidity flexibility. It's not like the equity market where you can go in and trade every day, but most of them will have quarterly ability to get capital, and some actually give you coupons on a monthly basis. So I see the private markets as a growth part of client portfolios over the 10, 15 years. Because if 3% of clients have private markets in their portfolio, and I'm talking about the whole wealth industry, that's a lot, right? It's very educated, very high net worth clients tend to have the higher percentages in their portfolio, right? The average investor hasn't gotten that in their portfolio yet.
Yeah, well, it's just been in recent years, right, that there's been new vehicles that we can invest in for that retail investor as well.
And I think what's also important for your clients to be aware of, how companies get access to capital in this country has changed dramatically. After 2008 and 2009, banks were put under very strict capital rules, and they don't have the lending practices that they used to have prior to 2008 and 2009. And many businesses did not have access to capital, hence the birth, the increase in the private markets. We're capitalistic and we see opportunity, and there really has been a tremendous amount of growth, particularly in the private credit side, in becoming a lender to businesses. And I think that is a permanent structure that's happened within our economy, that private credit is a form of accessing capital for many businesses.
Yeah, no, we here at Quorum are big believers in private credit as well, for exactly the reasons that you're describing. So I think we've covered everyone's questions, and Marianne, I really appreciate you being so generous with your time. I know this is a very busy time of year for you as well. And we were very fortunate to get our own private session with you here. To our attendees, thank you for joining us today. Thank you for the trust you put in us here at Quorum Private Wealth. I wish you all a great rest of your day and happy summer as well. Thanks for joining.
Thank you so much, Sue.
Okay.
It was really delightful. Take care.
Bye.